Hello and welcome. Thank you, Julio, for joining me on the ADU show. I'm excited to have such an expert in tax strategies centered around real estate development on the show today. Welcome, Julio.
Oh, my pleasure. Thanks for having me. It'll be a fun hour with you.
Yeah, well, Julio. Now let's jump straight into it, Julio. Can you tell me a little bit about you and why you're qualified to talk about taxes, real estate, and the market opportunity that we have today?
Well, sure. Yeah. Listen, I have the largest real estate tax credit and incentive firm in the country. We do work in all of the 50 states and across the world. We're really focused on wealth preservation for real estate investors. And how do we do that? We work through several thousand accounting firms. We're an engineering resource to them and their clients to make sure that their clients, these real estate investors, take advantage of all the federal, state, local incentives afforded to them, and to make sure that they use these incentives to, one, preserve wealth, two, to use that wealth to create more real estate, more jobs, and a better economy. And that's really our goal. Back in the 80s when I started my career, I was in the big four accounting world. And we were doing these real estate tax incentives for the Fortune 500 and the big, public companies. And really my goal was to bring these incentives to Main Street USA. And so what did I do? I started my own company, and that was to be a resource to the accounting community across the country and make sure that when their clients buy real estate or renovating their real estate, that we're able to give them these incentives through the engineering certification process. So, that I would say that's, my background and why I'm able to do these things nationwide.
Yeah, no, it seems like there's such a need for someone in your expertise, Julio. So, because most people that are developers or even builders, they're so focused in the weeds. They're trying to get their budget right. They're trying to make sure their contractors get paid, and smaller folks that aren't building 500 1000 homes on big site plans, they typically don't look into these kind of things. And even to a smaller extent, ADUs, right? If someone's building an ADU, they're typically just focused on trying to get this thing built, trying to get their permits approved, trying to navigate California bureaucracy, despite the state law making it easier than ever to build an ADU. But it sounds like there's still incentives available for anyone on that spectrum. I read a recent post that you had put online in the Bigger Pockets forums where you had talked about a $2,000 tax credit. And do you want to talk about that tax credit? Because from what you were writing, it's like not a lot of people perhaps are taking advantage of it. Yeah, I want to touch on that $2,000 tax credit, Julio.
Yeah, so that $2,000 tax credit, it's a federal tax credit. A lot of states match it. It's called 45L, and especially California, they match it. So what this is it's a $2,000 incentive for the developer when he's building residential properties, that each unit, and say it's a condo, it's a unit, or apartment complex units, or single family home, is energy efficient and meets the guidance of the federal guidelines. In California, if you're building, you're way beyond the federal guidelines. So you're meeting the federal standards. So that's a $2,000 credit per dwelling, right? That's a big incentive. California comes in and matches that. And $2,000 credit, that's cash, right? That's a dollar for dollar incentive. And again, most people don't take advantage of it. Now, the good thing here in our country, if you missed it, you can go back 3 years and fix your tax returns and get that refund. So maybe you've done this, you've already built properties and you've done it in the last 3 years. Well, IRS allows us to go back, fix our tax returns, and get those tax benefits. Now, again, most people, most states, you qualify. If you're in California, you way more than qualify, right? Because California has the highest energy standards in the country for building. And you don't want to miss that. And again, there's additional, beyond the federal ones, California, most states have a matching credit. So that could be up to $4,000 per unit. That's cash dollars. And that's a big incentive. Now, you said something that was important. Most developers just want to get it done. Most real estate investors want to get the project done and start getting the revenue. right? That's important. But you have to remember that, tax is important too. And I know that most real estate developers, it's about getting the cash, getting the project done. But you have to invest in accounting. Like, you can't think of accounting as an expense. Get a good accounting firm that knows real estate. Find that firm that understands your business, because if you're paying them a couple $1,000s, but they're generating 4,000, 6,000, 8,000, right? And we're going to go through a list of other tax credits, right? And tax incentives. And all of a sudden, that's a return on investment. Now, we got to remember that that could be part of your equity. That 4,000, that's another part of equity. The bank's looking at and saying, okay, we got more equity here for this project from the owners, and we're just on the tip here of what's a lot more incentives.
Yeah, no, I think that's a great point right there, Julio. It's like you got to build a team around you. You got to invest into things like your tax person, right? You if you want to go to a place where you're not at now, you got to do different things, and you have to align yourself with people accordingly. And that's why we're talking on the phone today, on the Zoom call today, Julio.
Yeah.
Now let's jump into some other tax incentives and credits. You've talked about energy tax incentives, disposition of assets, cost segregation studies, a 5G rooftop leasing strategy or incentive, excuse me, or even a credit. Can you talk about some of those?
Absolutely. Look, 179D is an energy efficient tax incentive for building property or renovating property energy efficient. So listen, the federal government says if you build a building energy efficient, now this is not residential, this is more commercial, right? But you build a building energy efficient, or you retrofit the building to be energy efficient, there's tax incentives. Now currently it's 60 cents a square foot for lighting if it's energy efficient, 60 cents for HVAC if it's energy efficient, 60 cents for building envelope, which is the roof and insulation factors for a building. $1.80 total per square foot. Now Biden wants to take that under the infrastructure bill to $3 a square foot. Again, this is a big tax incentive. How many people take advantage of it? Almost no one. And why? It's free money, but people don't realize they're doing all the right things. They want to make their buildings energy efficient to save money, but they don't realize the government's going to chip in on this. California matches it, other states match it, get up to $6 a square foot. That's big time incentives, right? For someone making their building energy efficient. Now, you said dispositions as well. So dispositions is like, all right, I'm taking out this old lighting. Now, in the government world, federal and state, that's a depreciable asset, right? And you probably have depreciation left on that asset. So maybe it's, you're taking out lighting, but maybe there's $20,000 of depreciation still on that asset. Well, most people don't realize, and they just keep taking the $20,000 over 39 years or 27 and a half years. But the asset's gone. You removed it because you put in a new asset. So now you can write off the remaining depreciation of that asset you took out. And it doesn't have to be energy efficient assets or assets that are energy related. It can be anything that you're taking out of a building. It can be the walls, it can be the carpets. There's a lot of depreciation left on that asset. You're taking it out. Make sure you write off the remaining asset, because you're taking something out to put something else in. And that's an important thing. You mentioned cost segregation.
Yeah.
This is one of the most important ones, right? This is a valuable benefit to all real estate investors. Now, we have two methods to depreciate a building, which is an expensive building over our federal tax code. One is the traditional method, which is for residential real estate, we write it off over 27 and a half years. For commercial properties, we write it off over 39 years. Well, look, I would say this. Why is real estate such a good investment? It's one of the few investments you get to expense. You get to write it off dollar for dollar, excluding the land value. Big benefit, right? You buy a stock, you buy a bond, you can't expense it. Real estate, you can. What a great tax incentive. Now, cost segregation study is basically an engineering firm that comes in, like we do for our clients in our accounting firms nationwide, and we determine how much of the building is non-structural. Right now, that could be 40 to 50% of the building. Whatever we determine is non-structural, now those are finishes, landscape, interior, finishes, things of this nature, HVAC lighting, things of that nature. That can be immediately expensed under a cost segregation study. So I buy a building for 10 million. The cost segregation study determines that the write-off is 4 million because that's the non-structural components of that building. Well, now I get a $4 million write-off. Now, let's do the math here, okay, real quick. Say I owe $2 million to the IRS. Got to write that check. But instead of writing that check, I'm like, okay, I'm going to take that same $2 million that I have to write to the IRS. I'm going to buy a building. I put the 2 million in, bank puts in the 8 million, or other tax incentives come in, bank puts in the rest, right? So we took that same 2 million that I was going to pay the IRS, bought the building. Now I did the cost segregation study. And from that, I get a $4 million tax write-off first year, right? So I eliminated the $2 million I owed the IRS. I bought an asset with the same amount of cash. And now I have income monthly from that asset. I get appreciation. Now that's how the real estate world, that's why we see these companies that are, billionaire private equity firms. That's why we see a lot of real estate investors that are billionaires, because what do? They preserve their wealth. The same money they would give the IRS, they put that into real estate and get a much better result. So this is vital. Cost segregation is, you cannot not do cost segregation if you're in real estate, right? Because why wouldn't you accelerate those write-offs? Then you add in that, okay, I built the building energy efficient, so now I'm going to get another $3+ per square foot. I'm going to throw in a little 45L. Maybe my building's historic, so we'll not put on some historic tax credits. Now, you brought up another thing. Like, we always thought that the rent comes from every floor in the building. You said 5G, Verizon, T-Mobile, Sprint, all these carriers, they want to be on the roofs of the buildings in California and every state across the country to reach their clients, right? Sure. And they have these initiatives. So they're trying to get on rooftops. So now the next generation rent in real estate comes from 5G. And you got to get that building on that list and make sure that the carriers are looking at your building, because they want to be on all those rooftops. And that rent, and remember, like, when you're getting carriers to look at your roof, don't give them exclusivity to your whole roof, because you can get 4 carriers on a roof, sometimes 5 carriers, right? You get all the big carriers, maybe a local carrier. Now maybe they're paying you $3,000-4,000 a month each, right? That could be your best rent, is that rooftop. So we have to think about that, right? So look, we talked about energy incentives, right? At the federal and state level, we talked about cost segregation. We talked about 5G. We know that if we renovate a historic building, there's federal and state credits to do that as well. That's another incentive most people miss. You and I talked about grants. Grants are available, right? But don't buy the building and try to get the grants, because then they know the states, right? They know that you're already in. But listen, every state wants a building to be alive again, right? So we'll see these buildings, and they're not paying taxes to the state because they're just not functioning buildings. So we have this historic tax credits, right? That we can bring these buildings back to life. We have all these other incentives that you and I talked about already. But there's a lot of grants available, because they give these grants. Why? Because they want that property to produce income, so that that property is paying taxes to the state. So, but you can't do it after the fact, right? Nor can you do historical after the fact. You have to get those in place before you start construction, right? And before really you buy it. So make sure you have those things in place, because those are vital things. Historic tax credits can be 30% of the equity of a building, right? That's free money. You sell those credits on the open market, typically to banks or family offices, at 98 cents, 97 cents on the dollar. That's free equity. It's free equity. So is the grants, right? And then we tap into all these other tax incentives. And now you start to put the picture together. Now you start to see why people invest in real estate, and maybe why they invest in certain real estate over other properties, right? Because if I'm buying a historic building and across the street it's not historic, that may be a big difference in the equity that I come in. Those banks know if you buy historic buildings, that's equity. And maybe you buy it in an opportunity zone, right? Where you never have to pay gains on buying a property in an opportunity zone when you sell the building. So now the building goes from 5 million to 20 million, no gains on that property, right? Because you bought it in an opportunity zone, a lot of opportunity zones out there in California and throughout the country.
Yeah, I do want you to talk about qualified opportunity zones. But one thing that you said, Julio, that I wanted to kind of dive in a little bit further on was you mentioned selling these tax incentive, these tax credits on private market. I think the example you just said was like 97 cents on the dollar. Talk about that. What lads, how does that happen? What does that look like? Because it was from like a broad perspective. It's like, hey, if you're building something, you have the tax credit. How can you sell this tax credit to someone else? Or maybe I'm misinterpreting it.
Yeah, so let's talk about that. So the historic tax credits, right? 20% federal. A lot of states match it up to 10%, right? So now you have 30% credits, right? So say now these credits are for, let's just go into the definition of historic tax credits. So you buy a building for $1 million. So those credits start kicking in over that $1 million threshold, right? So when you're buying a historic building, it's typically a whole new renovation, right? So say we're doing $5 million in renovations, right? So let's subtract that first million, right? 4 million, 30%, right? So now you got $1.2 million coming in tax credits, right? So typically what you do is with the bank, you would typically work with a bank that is involved in historic tax credits. The bank is typically buying those historic tax credits from you, and they're using that as your equity for buying that building.
I got you. So the bank is buying the credits because they're the lien holder, so they actually own the thing, right? So they can take advantage and do it that way. Is that kind of what you're saying?
Exactly. Now they, obviously, and that's, for them, the banks have to have so much CRA, which is Community Reinvestment Act, right? So they like these projects, they take those credits, right? So they take it as, they obviously buy it for CRA purposes and they sell it to their clients. But they take that as your equity piece. So now you're not even coming out of pocket for equity, right? Wow. You've secured that with the bank. They're going to take that. They put the debt in. And now, you got a project that is going to be very valuable, right? Because you're putting in these incentives. But you bought this building without cash because the credits were the cash. The bank bought those credits. They're also the lender on the debt. But if it turns out to be a home run, you did it tax efficient. Now, it doesn't exclude all these other tax credits that you and I have talked about, or tax incentives. So, but you got to look at those opportunities because I think those are very valuable.
Yeah, and it'll also seem, be in someone's best interest who's trying to go about that is to find an actual bank or a lender that could do this, because obviously not every very big bank or small, even credit union, small commercial lender would have the capacity for something like that. In your experience, is it easy to find banks that do stuff like this, or is it, hey, I found a few that work really well and I'll continue to cultivate relationships with them and help my clients funnel through them?
Yeah, I mean, there's always going to be a few banks in every community that specialize in this, and you just got to hop onto Google, right, and find those banks and call them and start to interview with them. Look, we talked about the importance of investing in an accounting firm or an accountant or a CFO that really is specialized and knows all these incentives. You got to invest in that bank as well. You got to have that banker that understands what you're doing, has the capacity to work with you. That's a big investment as well. Not having a good bank, we saw what that did for real estate investors during COVID, right? When they couldn't get access to these, funds and the PPP funds and all of that thing. So, look, if you're a real estate investor, better have a great relationship with the accountant. It's going to be a return on investment. Got to have a great relationship with the banker, especially during COVID or crises when these things are coming available. And none of these real estate firms, these small firms, had access to that banker and couldn't get, those PPP funds, right? Because they just didn't have the relationships. Vital. I think if we learned anything, you got to have those two relationships.
No, I 100% agree. I came from 15 years of working in banking, commercial lending, doing SBA loans and all that. And I was there during the pandemic, and you're absolutely right. There's so many people that were SOL trying to deal with these big banks and trying to get some CARES money. So
Yeah.
That's a great point, Julio.
Well, you bring up a great point. Look, if you had the accountant, he would have been able to get the information quickly. If you had the bank relationship, you could have had access to those care funds.
Yeah.
And listen, SBA, another great program that people don't take advantage of in the real estate community. And having a bank that knows, about these tax credits, about SBA programs, that's vital. The 7A program is a great program. We have the 504 program at the SBA. So there's a lot of wonderful programs out there, and having that knowledge, having that banker that knows about how to access, these different funds and have a relationship with the SBA is vital.
That knowledge gap is just, no matter where you are in your life, in your career, that knowledge gap can always be cut very short by having professionals around you. And I took a quick story. I was helping someone yesterday, and he's trying to buy this $1 million building, but he's in a lease to buy situation, and his lease to buy is only 550, and the valuation after an appraisal, it came back at like 1.3, right? So he has significant equity and upside, but the previous person that he was working with, someone who he entrusted with, was trying to find him financing for that, and the only thing that they were able to do for him is give him a hard money interest only loan. And I was just, and I know the in and out of this guy's business because I've looked at his tax returns, and I was like, have you heard of the SBA 504 loan, especially these days? I mean, you get in with 10% down, and the second it's like almost under 3%. It's a huge opportunity. So that knowledge gap is just so huge, Julio. And I thank you for circling back and touching on those. That's a good point. Now let's get into, Julio, qualified opportunity zones. I know you had briefly touched on that, and you said, in California, there's a lot of them. What are you seeing in terms of people who are taking advantage of them, people who are not taking advantage of them? What's the difference, and where's the biggest opportunity within the qualified opportunity zones, in your opinion?
Yeah, well, let's go back on the history of opportunity zones. We passed that in 2017 under the tax reform. And basically, what's great about opportunity zones is that it allows investors to go into projects in these designated opportunity zones in every state, right? Every state has the same amount of opportunity zones, right? The government dictated, and the governors of each of the states dictated these opportunity zones. And of course, these are low to moderate income areas. Okay, so what is great about an opportunity zone? So you have money, right? And you have capital gains because of something that you sold. Now that capital gains can be deferred into an opportunity zone, right? So it gets a deferral, right? Much like a 1031, and we know what 1031s are in the real estate world, great mechanism in real estate as well. Opportunity zones are a play of 1031 in the extent that you can defer, and 15% of that is ultimately forgivable. Now, the great thing about the opportunity zone is whatever capital gains you incur over a 10-year period in that building, basically, you don't ever have to pay them, and beyond the 10 years, right? So what an amazing thing. So look, I think, when I look at opportunity zone funds, the real estate project still has to be good, right? Because taking capital gains monies and getting some tax advantages to go into a project that's no good makes no sense.
Yeah.
But some of these projects are great. They're exceptional. They're bringing back communities. And there's other incentives, right? We don't stop with buying a project or putting our capital gains into an opportunity zone for this real estate project. Got to bring in all those other incentives that we've already talked about.
Yeah.
But this is a great way to bring back communities. And, we've always had tax incentives for low to moderate income communities, but we didn't have a mechanism for capital to come in to build the infrastructure, right? It was more related to jobs. Now it's, hey, we can build the infrastructure. And I've seen great projects across the country. I saw some great ones last week in Virginia, California, New York, where these communities are so viable, but they need that capital to come in. And this incentive, basically provides that extra, I guess you could say icing on the cake to come into those projects. So if you can find real estate that's in an opportunity zone that would attract capital that would not ordinarily go in there because of these tax incentives and the big upside, which is you don't have to pay gains. And that includes the businesses, right? So it doesn't, it's just not strictly real estate. But say you buy real estate in this and then you build your next Google, well, all that capital gains is forgiven, and quite an amazing incentive across our country.
Wow, it's quite a huge opportunity. Are you seeing, Julio, that mostly large institutional companies are coming in, taking advantage of these opportunity zones? Or are you seeing some smaller mom and pop ish type of businesses, developers coming in and taking advantage of these?
I'm seeing both.
Mm.
I'm seeing both at a significant level. We saw that the opportunity zone projects really died down during COVID.
Mm.
Right? I think COVID just kind of slowed or eased that incentive and that activity. But we've seen in the last 6 months these projects come back online, and we're seeing a lot of good projects, both at the big level, like you said, the corporate level, and the mom and pop, the small business owner level. I had the great fortune to be with Dr. Ben Carson to kick off some projects across the country, Ohio, and things of that nature. And so it's so great to see. And this is one of those great incentives. I think it has bipartisan support, like the energy incentives do. And I think that's great.
Wow. No, thank you. Thank you for touching on that, Julio. It sounds like in the real estate space, there's a lot of opportunities for people to offset costs, to gain incentives, tax write-offs, etc. And there's this huge knowledge gap, and it's so important to be able to be around professionals and people that can continue to support you on your journey. Continuing on that theme, Julio, if you could list off 4 or 5 tips, pieces of advice that you could give to anyone who wants to be a real estate investor, someone who wants to be maybe even a real estate developer, what are perhaps 5 things that you would give them a piece of advice on?
Yeah, we've touched on a few of them already, right?
Yeah, we have.
I think that, one is that part of the equity can come from all these grants and tax credit resources. So investing in that person that can help you navigate that, I think that would probably be your accountant, and understand your industry and understands all those things. You should have a checklist when you're interviewing your accountants, because that's going to be a valuable investment. The other thing we touched upon real quickly is having a good banker relationship that knows about these opportunities, knows about the SBA, right? You talked about an investor. If he knew about the 504 program, he wouldn't be doing hard money lending, right? I mean, that's a massive difference in that return on investment project, right? I think 3, identifying good projects versus great projects versus poor projects. I think you've really got to do your homework. I mean, a poor project can turn on you quickly. A great project will have a great result, but how do you determine that opportunity? You got to have a great ability to underwrite and understand the project that you're investing in. So you got to have that knowledge. You got to have those partners around you that can determine whether investing and building an apartment where there's no need for the housing versus doing so where there is the need, I think is ultra important. And look, you have to be able to pivot, right?
Mm-hmm.
Like COVID's showed us one thing. Maybe we're not going to have a lot of retail. Maybe we're not going to have a lot of office space. So be thinking about, okay, if things change, how do I pivot this property, right? And how do I maneuver this property? How do I get through these things, right? Because you always got to be leery of that emergency. We all think everything's great until it's not, right? And then ultimately, you got to be on top of, the climate, right? Are we going to have soaring interest rates? Do you not want to lock into a loan, right, with escalating variable rates and things like that? So you got to stay on top of your cycles, right? And those cycles are valuable, but you got to get into the good cycles and take the rise up. You don't want to be at the top going down. So those are some of the things I would share with the audience.
No, thank you. It's have a good tax person, have a good banker, pick the right property, and do your research.
I think those are valuable things, and obviously always, to an extent, make sure you put in equity
Hmm.
And whether that's collective resources, so to limit that debt limit so that you're not on the line all the time with the bank and having that pressure.
Yeah, you don't want to be over leveraged in today's climate,
That's
especially
right.
with everything going so well. Inflation, everyone's hitting home runs. It's just you want to be cognizant of the time in the market. That's also
Exactly
important.
right. Exactly right.
So, Julio, let's transition a little bit to accessory dwelling units, granny flats, in-law suites, guest houses, whatever you want to call them. They've been all over the world, really, right? You see them as used as vacation villages. You see them used to move in your elderly parents. You see them used as bringing in your college children. In California, this new ADU law allows people to add up to two ADUs. It's a state law, and every local municipality enforces it a little bit differently. You got to deal with California bureaucracy. But one of the biggest opportunities in my mind is these accessory dwelling units because it gives you the ability to, at minimum, convert an existing garage into a living space, right? And if you're converting an existing garage, it's not like you're building a brand new house from the ground up. Theoretically, you have three walls, you have some insulation, maybe you have a foundation, maybe you have electricity, maybe you have plumbing, right? It's a lower hanging fruit for people looking to get into real estate development than building a structure from the ground up. But it's hard to do and it's expensive. In these types of opportunities, one couple of things that I've heard people intimidated about is, hey, if I add this accessory dwelling unit, my property value is going to go up, so my annual tax rate is going to go up, despite the income I'm making. And also this idea of a initial negative cash position that makes the ADU not feasible. Can you touch on those two subjects?
Well, listen, I don't always agree with California politics, especially when it comes to real estate, but I think this was a great legislation that they passed and signed into law last year. Um, I think, or this year. But what I think is important is that, the government here recognized that they need more affordable housing. And they desperately needed to do something to create housing in that market. And this program is perfect for that because it really kind of lays down the bureaucracy and allows, investors, really real estate holders, to do these projects, split up these projects, create more housing without all the bureaucracy, without all the red tape. So,
Yeah,
when government gets out of the way, and
it's a good thing for everyone.
it's a good thing, especially for that market. Now, look, I understand that you're going to have issues doing this with negative cash flow, things of these nature, right? But again, remember, we've already shared with you how you can get some of this free equity, right? How you can be on top of this. And listen, banks understand cash flow. You understand that being a banker, and so they'll get behind a project with you when they understand the mathematics, right? So again, having that important banking relationship, having an accountant that can help you with these cash flows and understand that there's going to be other incentives layered on top of these programs to do this. Look, I think it's a home run for real estate investors because anytime you have new laws, that means you have a new tax advantage or a new regulation advantage that didn't exist. So now it's first come, first serve, right? I mean, be at the front of this market, this opportunity. Look, you still have low income housing credits, you have new market tax credits. We're rich are really about affordable housing, but you have to maybe layer these in as well. So you have to again have that partnership. But ultimately, these things are great things because again, first adopters to these that are finding the opportunities, good opportunities to basically create more housing, layering in the incentives, layering in that good accountant and banker to facilitate these tremendous things.
Wow. Thank you. Thank you. So Julio, what types of clients are you helping these days?
Well, when you work with accounting firms and their clients, you get everything they send your way. So we get the small business owner that's, creating, improvements to their building. We, do large projects like the new Las Vegas football stadium. You know, we
Mm.
do high rises, but we do dental offices, we do car washes, we do everything out there. Anything that's being built or renovated, we help those clients with. I think it's important that everyone have access to all these tax incentives. And that was
Absolutely.
really the mission when I started this company, is to make sure every person here in our country that's investing in real estate and doing so with energy efficiencies and, you know, affordable housing and all these other opportunities are richly deserving of these tax incentives, that they get those, that those tax incentives help them create more properties, more wealth, more jobs, and a better economy here in our country.
Wow. Well said, Julio. Given that, what's an ideal client for you right now? If someone's listening to this show and they're thrilled with all the information that you've been able to give them, Julio, and they're inquiring, what's an ideal type of client for you?
Well, for me, listen, if you're buying real estate of any kind, if you're renovating properties of any kind, you're the ideal client. You're the person that's investing in our country. You're the person that's helping grow our economy. You're the person that's giving affordable housing to individuals. You're providing shelter for people all across the country. You're taking that risk, and through that risk, you're creating a better community. And so you're the ideal client.
Oh, that's awesome. No, thank you, Julio. One of the biggest opportunities in the space and what I'm seeing with accessory dwelling units, Julio, is these small apartment buildings. These small apartment buildings that have detached garages or carports. With the new ADU laws, you can convert up to 20 to 25% of those into accessory dwelling units. And I think that's one of the biggest opportunities here in California, to be able to buy these small apartment buildings and add additional units. Um, is there anything that you're really jazzed about these days? Any opportunities, anything that you're seeing in the market that you're like, hey, if I was that person, or hey, I am that person, then this is what I'm really looking at?
Well, I think this is one of the best that you're talking about, because remember, not many people are going back to the offices, right? They're
Mhm.
working from their place where they live. And more and more people are looking for a place where they can work from home and, have a low cost, affordable place to do that, and start, getting through this recovery. So I think these type of affordable housing projects, whether it's under the California program or nationwide, are vital, because people are trying to work from home. And I don't see a lot of people going back to work in the
Yeah.
big buildings. So I think that now on the big building side, right, we're seeing big buildings where they're converting to apartment complexes, right? They're not
Are you
going
seeing
back
a
to,
lot of that, Julio? Are you seeing these older, not even necessarily older, but these office buildings being converted into housing spaces? Are you seeing a lot of that?
we are. In fact, I've seen some significant projects in New York,
Hmm.
where they're taking these big high rises and converting it to affordable housing, kind of these micro units for people.
Yeah.
And listen, that's going to continue on, right? We have hundreds of employees, and at one time they were all working in offices. Now they're all working from home. I don't see them coming back, and I think it's good for both parties, right? I think it's good for the employee and for the employer to have a happier, you know, culture. But ultimately, what does that mean for real estate? It means that we're not going to have the office space, right? We see the malls going away. What's happening to the malls? They're becoming distribution centers, right?
Yeah.
The Amazons come in. So we're seeing projects like that. What we're seeing is that things are changing, right? Just malls are becoming distribution centers. High rises are becoming multifamily units. In California, they're coming up with creative rules to help create these subdwellings. And so we got to stay on top of this, and continue to see how this is all going to change, and are people going to come back to offices? I don't know about that, but there's certainly a need now for people that want a nicer space to work from home, because that's, not only their home now, but that's their workspace. So we're seeing a lot of that.
Yeah, the trend is continuing to rise for these micro units, people living in smaller spaces. I see that continuing to rise, but also people using their ADU or their backyard or their garage as a home office, because, there's not necessarily a return to work plan for them, right? Or they found another solution.
Well, I think you're right. And I think the other thing is you need affordability, especially in California. I don't know how these young people, especially in some of the tech areas, have an ability to, afford housing. It's super expensive. Even during all this, it has remained relatively expensive. So now we have these opportunities where people can create more affordable housing for these young people. And, and so finally they can start saving a little bit of money. And I think that's just wonderful. I mean, it's desperately needed there because of how high the rents have become. And
That's
that's
so
not
true.
going away, right? So now
Nope.
maybe this will help out.
Yeah, no, there's so many property owners that have just chosen to keep their buildings vacant because they don't want to lower the rent, and then they're going to be subject to some type of rent control if they're trying to increase it. So some property owners are, I'm just going to leave it vacant. I've seen that so many times. So
Yeah.
no, that's a great point right there. Wow. Okay. Awesome, Julio. Any parting thoughts and how people can get in contact with you if they want to connect with you?
Parting thought. So I just want to touch on one thing you brought up, property taxes, right?
Yeah.
So in property taxes, right, if you're owning real estate, you can appeal your property taxes every year, right? And more important, listen, they're not going to take down your taxes, but during this past 2 years of COVID, this is the time to appeal your property taxes because obviously the revenues have come down. California, you have Prop 18 and other things to, help keep those taxes lower. But you got to appeal it every year. If you're a real estate investor, you owe it to yourself to appeal your taxes, property taxes. So I think that's important. Like, I hope that, what you do helps so many people out there. I hope that collectively these synergies help everyone that really want to be in real estate. What I will share with you, and we talked about this, is that maybe you've missed these tax incentives at the federal, state, and local level. It's not too late. Like we said, you can go back 3 years and get these refunds. Now, these refunds can maybe help you for the next project. So you missed these tax incentives. Let's go back and get them, right? Let's go get those refunds. That can provide a lot of capital to you to invest in that next project. So I would leave you with that. Like, we're available at www.engineeredtaxservices.com. We put up great real estate tips every day. But again, we're not the accounting firm, right? We work with your accounting firm. We work with your CFO. We're the partners that help with these tax incentives, these real estate tax incentives, the 5G programs, to make sure that you're taking advantage of those. So you don't have to change accounting firms, and we're paid on success. So if we get those tax benefits for you, it's good because you're not putting out money to pay us.
That's awesome. Thank you so much, Julio. I appreciate all the insight that you've been able to share on the show today, and I'm looking forward to learning more from you.
Well, listen, I appreciate what you're doing. Again, knowledge is powerful, and it's just that the IRS is not going to tell us about all these tax incentives, right? They're not going to go promote it, but you've helped cover the basis a little bit. This is a great start. Hopefully you'll have me back on and we can dig a little bit deeper or go. Like, the one thing too, tax laws never stay the same, right? So we know the infrastructure bill's coming up. We know that they're going to raise taxes, right? So What are we going to do as real estate owners to deal with these higher tax rates that are coming at the federal and state level? Well, maybe that's our next program.
Yeah. And I'm really excited about the rollout of SB 9 and SB 10. And I'm definitely, we will connect again. Thank you, Julio.
Oh, my pleasure. Thanks for having me.
Yep.
Thanks for watching. If you're interested in building an ADU yourself, check out my 5-week ADU course, where I teach you how to build an ADU from start to finish. Click the link in the description to enroll now. See you on the other side.